Greetings, this is going to be another video in our CrashWatch series because more and more factors that portend to a stock market crash in the major US index, which is the S&P 500, continue to manifest, and I'm going to list out what those factors are. Some of those repeat the various concepts introduced in the other CrashWatch videos, but as weeks have passed since prior videos, an update is warranted. So this is the S&P 500 over a 2-year chart. And this is the S&P 500 over a 5-year chart, and I believe we are in a very vulnerable situation that could lead to the S&P 500 crashing all the way down to the low 3000s, which is about here. As you've seen from other crash watch videos I've had on this channel, I've had a very high accuracy rate in predicting both stock market tops and bottoms, simply because certain indicators make it very, very obvious. And you can watch some of those other videos to get a feel for all the time-stamped predictions I've made on LinkedIn, Twitter, and so forth. And I'll go through those in other videos, but I don't want to do that in every single Crash Watch video. So I've put forth a couple of PowerPoint slides where I list out all the factors that portend to a crash and the reasons that there might not be a crash, and then we can weigh the two lists against each other to assess our own probabilities. So we go to the PowerPoint. So reasons for having an S&P 500 crash. Reason number 1, head and shoulders pattern on the S&P 500 chart. And reason number 2, high oil prices reducing corporate earnings and consumer spending. So we go back to the chart to look at reasons 1 and 2, and then I'll come back here for the remaining bullet points on this slide. So as you can see here from this 5-year chart, we've had a big run up, coinciding with the amount of money printing that was done in response to the COVID-19 crisis. And that was an appropriate amount of money printing to be done even if we did not have COVID-19. Those of you familiar with my Atom thesis have read that I believe this amount of quantitative easing has to be exponentially rising just to offset technological deflation, because QE in and of itself does not cause inflation. Small episodes of inflation here and there happen for reasons other than quantitative easing, as I'm about to speak about. So this is the 5-year chart of the S&P 500. If you go to this 2-year chart, you can see this large run up, and you have what is called a head and shoulders pattern that I've spoken about before. The left shoulder is a first high. The head is the new high that comes after a brief correction. It looks like the market is making higher heights. And then there's a correction, which is the neckline after the head. And then failure to make a new high after the second high is known as the right shoulder. So you have shoulder, head and shoulders pattern. The fact that the stock market has not made a new high or anything close to it after the first high is a very bearish indicator, because you see this head and shoulder pattern that is occurring. And as you saw from the 5-year chart a minute ago, we haven't had a large correction in quite a long time, and this is a very, very classical indicator. The Russian invasion of Ukraine pushed the stock market down here a little bit, but the shoulder was not ready to complete itself because enough time hadn't passed to make this shoulder approximately the same length as the left shoulder. Now, they don't have to be equal, but this was clearly too soon for the stock market to correct, because that was not a shock event of sufficient magnitude. A larger shock event can certainly tip a market into correction when it's more tired of a bull market, and as weeks pass, this becomes more tired. If you get more negative news out of the war in the Ukraine, it could tip it over, or the stock market could correct independent of news from there, simply because of other economic activities going on, such as Federal Reserve tightening, which I'm about to talk about. So this is a very clear head and shoulders pattern. I've spoken about this before, but this doesn't happen very often. It doesn't even happen once a year. It happens once every few years and is usually an extremely bearish indicator for the S&P 500. So this was chart number 1. Now I'm going to add oil, which is the other factor that you saw in the first 2 bullets. So I'm going to take the oil chart, and this is a 1-year chart of the S&P 500 with USO, which is a US WTI oil futures ETF, West Texas Intermediate Oil Futures. So this was the S&P 500, and since this is a 1-year chart, this was the basic head and shoulders pattern that we saw. And see how oil was rising, this light blue chart, which is USO. Dark blue is the S&P 500, light blue is USO. And because the United States stopped domestic oil and natural gas production, oil started to rise. And as oil rose, a lot of oil exporting dictatorships started to get bold, such as Russia, but also Iran and others, and that shot up oil prices even more. Now, over the medium term, not even long term, over the medium term, this causes tremendous oil demand destruction in the form of EVs, in the form of more advanced fracking technologies to lower the cost of hydraulic fracking even more, and even outright displacement of oil-based transportation in favor of telework and telemeetings using Zoom and other such video conferencing technology. That's an even higher and more technologically pure demand destruction of oil. But in the short term, this is very bearish because everyone is paying more for gasoline, but that cost, when businesses bear it, also gets passed on to consumers in the form of everything else, and the CPI is rising. So that is eating away corporate profits and eating away at consumer spending. So this is the 1-year chart of oil in relation to the S&P 500. The 2-year chart is this. You can see the S&P 500 rose a lot, but oil rose even more. So you can see how this oil might be taking away from the earnings of corporations in the S&P 500, as well as the demand that consumers have for the products produced by the big companies in the S&P 500. And remember, the S&P 500 is about 98% of the entire US stock market's market capitalization. All those big tech companies are in the S&P 500. So now we go back to my PowerPoint slide to look at the next factors after these first two. So what are the factors after the first two? Federal Reserve rapid quantitative tightening, which has caused the last 4 crashes. I don't want to belabor this point because a lot of videos on this channel are about that, but I urge you to merely look at the video I produced right before this one, which you can see in this card up here that I'm pointing at, which explains how the Federal Reserve has not merely stopped printing $120 billion a month, which caused that rally, but is now tightening to the tune of another $95 billion a month. So in a short time, they have tightened to the tune of $215 billion a month. 120 billion a month of printing has stopped, and now they're reversing that to the tune of $95 billion a month. $215 billion a month of tightening. Now, what they choose to tighten should allow some flexibility, whether shorter term treasuries or longer term treasuries or more mortgage-backed securities or less in a particular month. But in general, in those monthly monetary creation videos that I produce each month, we are going to track that closely. And the stock market might crash before even I produce a next one, but we'll see how long it takes for the stock market correction to manifest in the face of this tightening. Tightening is the last thing they should be doing. They don't realize that even if the big rise in the stock market means a large crash from here merely takes the market to the highs of 2019, merely to the highs of 2019, that is still very recessionary because people react to what they lose relative to their high point. If the Federal Reserve is going to tighten, they should not inflate the stock market that much in the first place. That causes less sophisticated people to buy at the top, and they lose more money, unless this is in fact their intention. Some people who believe in conspiracy theories say the government is doing this deliberately to destroy the middle class further and to concentrate wealth into fewer and fewer hands. I don't think that's true, but the Federal Reserve is so theoretical that they don't realize how much their actions actually cause damage to average people across the country and across the world. And now the fourth factor, the next few years of home buying has already happened, and this is a factor cumulative to all of the ones above. To see what I mean by saying the next few years of home buying demand has already been used up, look at this video up here in this tile, which is actually the first of a 2-part series, so you should watch both of those videos, and you will see how the low interest rate environment that the Federal Reserve created, in fact, caused a huge boost in home buying that used up a lot of future demand. Now, I just said that they should be printing more. Yes, that's true, but the type of money printing they do is already super saturated in that the US Federal Reserve, despite the $9 trillion of money printing they have done, has only been the purchase of 2 different things, US Treasuries and mortgage-backed securities. So all it does is distort those 2 asset classes, which means more federal government spending because they can issue debt at lower rates, and more house buying because they're trying to prop up one asset class because of the belief that it would be politically disastrous to have people in negative home equity. Unfortunately, this causes a tremendous amount of distortion because, as you will see in that video that was in the tile that I just pointed to, Anything that the Federal Reserve does to increase home prices simultaneously triggers the construction of new homes. And now in the Zoom and telework era, different cities compete with each other. It used to not be the case that home construction 50 miles away from an expensive area was a supply increase that could reduce prices in the expensive area, particularly if that area was artificially restricting supply construction due to zoning restrictions. But now the zoning tax is greatly weakened. I talk about the zoning tax in this video up here, and the telework revolution and the associated tools for it, such as Zoom and a whole host of other video conferencing technologies that are going to emerge in the near future, is a very large deflationary effect on artificially high housing prices. The United States has set up too much of the entire economy under the premise that home prices just go up and that you should get a mortgage interest deduction and things like that. And that whole house of cards could fall down because a house structurally is just a wooden box and the materials deteriorate over time. It rises in price due to its proximity to jobs and people competing for this artificially restricted resource and the deliberate non-construction of more supply of housing. But the telework revolution is going to cause a downward pricing in housing, and the Federal Reserve, by buying mortgage-backed securities, just can't do that. So more money will leak from the Federal Reserve into lower cost housing places and into the atom economy, into technology, because home prices and the entire housing market is just a sieve for such. So these are the four factors that could cause a major crash in the S&P 500, after which the Federal Reserve will print more and the stock market will rally, but they will be forced to buy more than just treasuries and mortgage-backed securities. They have to give cash directly to people, as I detail in great length in my Atom publication, and all market forces in that direction. They just have ideological rigidity that prevents them from doing that, even though that would be the most diffuse and dynamic and flexible way to keep the economy stimulated and in a higher speed of cruise control and for greater human flourishing. These are the four reasons for an S&P 500 crash. Now, what are the reasons that the S&P 500 will not crash, and are those reasons sufficient? These are reasons for no S&P 500 crash. Reason number one. Are other central banks going to offset U.S. Federal Reserve deprinting? As you often see from my monthly updates on monetary creation, the most recent of which is in this video over here, the United States is just 25% of all world money printing. And I don't want to repeat that chart because I show that chart in just too many other videos, but go to that link that I just linked to so you can watch that if you haven't seen it already. And if other central banks of the world, such as China, Japan, and the EU, print enough money to offset the absence of US printing and the reversal of US printing, then there's enough worldwide net printing to prevent the S&P 500 from crashing, or at least make it less severe of a market correction and perhaps spread out over more time. That in theory could be the case, but the moment other central banks are not printing enough for that to occur. But that could be a cushioning effect that allows the Federal Reserve political cover to pretend that they're tightening when actually they're not. Longtime viewers of this channel know that ultimately all money printing is worldwide, and the US is only one of many central banks and is only a 25% contributor. That's why it's equally crazy for people to say that the US printing money, the US Federal Reserve, is somehow going to cause a worldwide price commodity like gold to go up, as if the US is the only country in the world. And I make fun of that ignorant meme that people like Peter Schiff and others propagate in a lot of other videos on this channel. We don't have to elaborate on that over here. But now on the second factor, this becomes pretty far out and is some wishful thinking. I personally don't believe this is a factor that's going to save people who are long the market right now, is a technological and economic singularity sooner than we think. Now, the accelerating rate of change leads to accelerating economic growth, as I speak about in this video over here. That's why half of all economic progress has occurred after 2000, and the stock market continues to rise in an exponential trend. The inherent internal rate of return of the stock market is rising, and this rise is more concentrated in technology, namely the NASDAQ 100 index, which is a subset of the S&P 500. That's why technology becomes even a bigger subset of the S&P 500. But the problem with this is that what if the accelerating rate of technology just leaves the human monetary system behind? And if the atom, the technomic medium of the world, and whatever first principles of the universe that are enabling the accelerating rate of change decide that humans are the bottleneck, humans are holding things back, then the accelerating rate of change leaves humans behind, and we have an accelerating superintelligence that isn't dependent on humans making money or anything like that. and the S&P 500 doesn't grow from that. So even if we think that a technological singularity is sooner than I say it is, I say it's in 2062, I believe that is too far away to save us from a stock market crash right now, because there are going to be a lot of corrections between now and then, even though the general gradient is rising. If you believe the singularity is a lot sooner than that, such as 2045 as Ray Kurzweil thinks, that's a slightly better cushioning effect because we are further along in the accelerating second derivative of the trend line than a 2062 scenario might indicate. But at the same time, if the technomic medium of the world is destined to leave humans behind and the human monetary system behind, then the singularity being sooner is not a bullish sign either. So these are the only two reasons I can think of why there will not be a large stock market correction in the very near future, and neither of these factors are particularly all that convincing, given that for point number one, the central banks of the world are not at the moment ramping up their money printing to compensate for US tightening, and number two, that is really far out, and you have to believe in a technological singularity that includes humans and that it's a lot sooner than 2062 for this to be a cushioning effect to the stock market. But I thought I would include this bullet just to account for everything I could think of. So now we go back to the S&P 500 chart. So this is where we are with oil and the S&P 500. Oil is really adding additional pressure to the S&P 500, even though the head and shoulders pattern was forming before oil. And the oil price spike is causing temporary inflation that is being attributed to the Federal Reserve. Now, if the Federal Reserve had any ideological consistency at all, they would have the courage to say, hey, this inflation is not because of us. It is because the US halted oil and natural gas production. And if they allow oil and natural gas production to resume like it was for the prior decade, then we would not have the inflation we're seeing right now. So there's no need to tighten. If I take out oil and get back to the S&P 500, this is a head and shoulder pattern. This is bearish. In the 5-year chart, you can see we haven't had a big correction for quite some time. This was the COVID-related correction, but there was even a run-up before then, so that was an unnaturally high peak in the first place. If you look at this trend line, this is kind of where we are, and I say a correction down to the low 3000s is a high probability event, and I don't know exactly when it's going to happen, but these negatives are piling up. So caution is warranted. Beware. The medium and long-term future is certainly bright, and don't necessarily do anything drastic if it was not part of your long-term plan, in that if selling stocks would trigger a taxable event so that you have less money, then buying at a lower price is not a risk you necessarily want to take because you're only buying with after-tax money anyway. That's just not how our tax system is structured, and our tax system is structured wrong anyway. But under that reality, maybe you don't want to do anything and just ride this out and expect 25% of a correction to occur, and it could take a while to get back to the high water mark, but so be it. But this is just some information that enables you to make your own conclusions. I'm not telling you what to do or what not to do, and while this video is very relevant to the time it's published, it's also going to be useful a year from now, 2 years from now, 5 years from now, because I'm teaching people about fundamentals of the market. So this video is going to be relevant even long after an eventual crash occurs, because it's part of broader stock market education that once again enables you to make your own conclusions. I'm not telling anyone what they should or should not do, just how to interpret this data and what to look at that might be important versus what to avoid because it might be a distraction. Now, if you found this video to be informative and you like this type of content, then I encourage you to upvote this video and subscribe to this channel if you've not already. Thank you very much for watching.